Want to buy a home but have bad credit? Want to buy a home but cannot qualify through a traditional bank? Then this video is for you. My name is Chevy Harris. I am a licensed real estate broker with Coldwell Banker, and I'm also a real estate investor. If you're new to the channel, thank you for tuning in. So we're going to jump right into it. There are many ways to obtain home ownership without going through a traditional bank, or at least for the time being. But we're going to talk about one specific today, and that is seller financing or subject to. And we're going to get into both today. So, what is seller financing? Seller financing is literally when the seller of a property is willing to act as the bank and carry the mortgage for roughly 3 to 4 years before you, the actual buyer, can obtain a traditional loan through a bank. Now, this method usually comes with a down payment, although it does not have to. It does come with a down payment traditionally to the seller between 3 and 10% down, with monthly payments that traditionally goes towards the principal of whatever the purchase price was. Sometimes there's interest involved. So this goes on for about 3 years, sometimes 4 years. It all depends on you guys' term, to the point where you can actually qualify for an actual mortgage. Now, once you make the initial agreement, you do become the owner of the property. That is recorded, and the seller, so you will be the homeowner, and the seller will have a lien against the property. That lien will be released or uplifted after all the terms of the contract that you and the seller has agreed upon is totally complete. Now, at that time of completion, you should be able to completely qualify for your new mortgage. Granted, you've been working on your credit for 3 to 4 years. You do have a steady stream of income, or W-2, that banks will allow. And there are a lot of different loan programs you will qualify for. But the biggest thing is you being able to pay the seller back with the agreed terms. And that comes traditionally through refinancing or cash out refi. Now, the difference between those two is a traditional refinance, you will just you will probably make little money, but the seller would be paid off completely, which you guys agreed up terms. Now, if you do a cash out refi, that means that you put a lot more equity into the property when you bought it, and now you have money left over, which you can use for whatever, and the seller's been paid.